It's no secret that history repeats itself, and when it comes to the stock market, investors will perform whatever mental gymnastics are necessary to convince themselves that this time, it's different. Legendary investor Sir John Templeton, who averaged 15% annual returns for 38 straight years, called those the 4 most expensive words in the English language. And he was absolutely right. Because nothing drains a brokerage account faster than blind optimism disguised as financial brilliance. Which brings us to Jesse Livermore. Jesse Livermore, who is considered a pioneer of speculative trading in the markets, was the basis for the main character in the best-selling book Reminiscences of a Stock Operator, and is most well known for making his fortunes by shorting markets during crashes. He once said, "There is nothing new on Wall Street. There can't be. Speculation is as old as the hills. Whatever happens in the stock market today has happened before and will happen again." And there's a stock market bubble almost nobody talks about anymore. A bubble that looks disturbingly similar to today's market. I'm not talking about the dot-com bubble. I'm not talking about 2008. I'm talking about something older. A bubble that, when it burst, wasn't pretty. The market collapsed 50%. Some of the largest companies on earth lost 60% to 70%, or even 80% of their value. Inflation surged from 3% to 11%, and the market didn't fully recover for 8 years. I'm talking about the Nifty 50 bubble of the early 1970s. The story begins in the late 1960s. The United States had just finished a 20-year economic sugar high after World War II. Factories were booming. Suburbs were popping up out of nowhere like acne on a teenager. And Americans believed the country was invincible. People had money, they had confidence, and most importantly, they had blind optimism. And why wouldn't they? The U.S. had defeated Germany in World War II, put a man on the moon allegedly, and, most importantly, invented the Etch-a-Sketch. Life was good, and right in the center of all that optimism sat the stock market. From 1945 to 1970, the U.S. stock market gained more than 350%. After a run like that, investors stop asking if prices make sense. They just assume stocks only go one direction: up. That's when a new investing idea became popular. It was called one-decision stocks. The concept was simple: buy companies so dominant, so powerful, that there's only one decision to make: buy. These stocks became known as the Nifty 50. They weren't penny stocks. They weren't risky startups. They were blue-chip giants like Coca-Cola, American Express, and McDonald's. Household names, reliable cash flow machines. Investors believed they were bulletproof. And because of that belief, selling them was considered insane. But here's the thing about investing. If something sounds like a no-brainer with zero downside, it's usually a financial grenade with the pin already pulled. And that's exactly what happened. By the early 1970s, the Nifty 50 weren't just expensive. They were priced like gravity didn't apply to Wall Street. The average P/E ratio for the overall market was about 15. Respectable. Normal. The kind of number you could proudly introduce to your parents. But the never-sell mentality pushed Nifty 50 valuations into fairy tale territory. Coca-Cola traded at 46 times earnings, Xerox at 49, McDonald's at 86, Polaroid at 90. On average, the Nifty 50 traded at a staggering 42 times earnings, and it doesn't stop there. At their peak, the top 5 Nifty 50 stocks made up about 25% of the entire market. The full group, roughly 45% of the total U.S. stock market. Then came 1973 and 1974. The dominoes fell. Oil prices quadrupled. Inflation jumped above 11%. Unemployment doubled. And President Richard Nixon ended the gold standard. The market plunged 50% between 1973 and 1974, the worst bear market since the Great Depression. And when the economy falls apart, overpriced stocks don't gently correct. They get destroyed. Coca-Cola dropped more than 60%. McDonald's fell over 70%. Polaroid collapsed more than 90%. The so-called one-decision stocks turned into one massive financial obituary. And here's the real punch. The recovery wasn't quick. It wasn't smooth. It wasn't pretty. It took 8 years, until 1981, just to get back to the previous highs. Investors who thought they were buying eternal growth ended up stuck for nearly a decade. Now fast forward to today. If you're feeling a little déjà vu, you're not alone. As Mark Twain said, history doesn't repeat itself, but it rhymes. Back in 1972, the Nifty 50 made up about 45% of the US market. Today, the Magnificent Seven make up around 36% of the S&P 500. 7 companies: Microsoft, Apple, Google, Amazon, Meta, Tesla, Nvidia. They carry the market. Are they innovative? Yes. Do they dominate? Yes. But so did Xerox, so did Polaroid, so did Avon back in 1972. And just like then, investors are acting like there's only one decision to make: buy. Now look at valuations. Google and Meta trade around 28 times earnings. Amazon at 35. Apple at 37. Microsoft at 38. Nvidia at 50. Tesla at 247. Great businesses? Absolutely. Priced like they can never fall? Also, yes. As Warren Buffett once said, what we learn from history is that people don't learn from history. And here we are again, staring at a top-heavy market, pretending valuations don't matter, whispering the 4 most expensive words in the English language. This time it's different.